Welcome, dear traders. Despite the forecast, the results of yesterday's close on Wall Street managed to surprise investors. Let's take a look at today's economic data and how the major currencies in the Asian region are performing. At the end of yesterday's trading, US stocks showed one of their best months in a decade. Wall Street's November rally took place against a backdrop of a weak economic data. This week's US price reports reinforced bets that the Fed could begin to unwind its monetary policy in just a few months. Comments from Federal Reserve speakers echoed this sentiment. The tightening cycle was likely over, and some policymakers signaled. Other speakers supported the need to keep rates high for a long time. And today, Jerome Powell may shed light on the US monetary policy in his speech. However, his statements will rely on the same reports on the prices and the labor market. These reports point to the weakening of the country's economy under the pressure of high interest rates. In contrast to the US stock market, November was the worst month for the US currency. The US dollar index lost 3% against its six counterparts, despite support from Treasury yields, which hit record highs in November. On December 1, both 10-year and 2-year Treasury bonds were also holding the yield bar quite high at 4.33 and 4.68 respectively. Against this backdrop, the US dollar was able to correct yesterday's volatility and consolidate near 103.30. In the Asian trading, the greenback struggled to attract further buying. The US dollar index traded within a narrow range of 103.20 and 103.40, awaiting fresh signals from the Fed. The US dollar's chart reflects that the US currency is sensitive to policymakers' speeches. Yesterday, the greenback was showed turbulent after speeches from New York Fed President John Williams, of the San Francisco Fed President Mary Daly, and the former said that the central bank's policy should remain restrictive for quite some time. Meanwhile, Mary Daly noted that her baseline scenario did not include further rate hikes. Let's return to the economic data for the Asia-Pacific region. In Asia, the manufacturing PMI remained weak in November due to the sluggish global demand. In addition, the outlook for the region's fragile recovery is overshadowed by China's economic data. However, the manufacturing index unexpectedly rose to 50.7 points today. That's it. Grows to the 50 mark that separates expanding from a contracting. And this data was released the day after the official report. In contrast, yesterday's reports showed a contraction in both manufacturing and services sectors in the world's second largest economy. And this means that factories are hiring fewer workers and producing less. In any case, China's domestic market is not able to fully compensate for the loss of supplies to Europe and the United States. Japan's export-dependent economy is also suffering from a sagging global demand. Japanese manufacturing data showed a contraction to 48% against the backdrop of falling export orders. The index hit its lowest level since February. Employment also dropped, and inflation hit its lowest level since July 2021. Meanwhile, real wages in the country have fallen for 18 consecutive months. The Japanese companies are under pressure from government policies. Prime Minister Fumio Kishida urged companies to raise workers' pay to outpace inflation. So, large companies have reached an agreement with the labor unions. According to the agreement, employees will get the biggest wage increase in 30 years. Depending on the company, the increase will be between 3% and 6%. In this case, the Bank of Japan will be able to abandon more than a decade of monetary stimulus to the country's economy. The Japanese currency will likely strengthen on such prospects. The Japanese yen continues to strengthen against the US dollar for the third week in a row. On Friday, the dollar-yen pair was trading within the range of 147.50 and 148.30, maintaining bearish momentum. By the end of the Asian session, the price broke through the 148 mark, moving toward the second technical support at 146.90. The next resistance levels for the pair are located at 148.30 and 149.60. However, the US dollar's momentum generally determines the movement of the region's currencies. As a result, the AUD consolidated within a narrow range of 0.6600 and 0.6631 today. Meanwhile, the Australian dollar attempted to break out of the flat as the oil prices jumped. The currency was also supported by optimistic data on the Chinese economy. However, it was not enough for the AUD to fix the gains. Nevertheless, the AUD-dollar pair is still trading above the critical 0.66 level, and the pair was trading in the green, rising to the level of 0.6623. The New Zealand dollar showed signs of a growth today, maintaining bullish momentum within the range of 0.6151 and 0.6193. However, the Kiwi is unlikely to reach the first technical resistance level of 0.6222. Given yesterday's slide below the 0.6130 level, such a sharp drop may happen again, especially if the US dollar strengthens. The Indian currency is also gaining strength. On the first day of December, the rupee was supported by strong domestic statistics. India saw increased activity in the manufacturing, mining, and construction sector. However, domestic demand remained the main driver of economic activity. Recent reports showed that country's GDP grew by 7.6%, making India the fastest growing major economy. On Thursday, Prime Minister Narendra Modi said that the GDP data showed the resilience and strength of the Indian economy in the face of global challenges. As a result, the dollar-rupee pair strengthened in the 82.35 and 83.35 range today. However, the pair remains bullish. In November, the euro-rupee pair climbed to a high of 91.56 from 87.93. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you next video.